The amount of transfer of wealth that's going to happen probably over the next 2 to 4 years is going to be astronomical. You just got to pivot with the times, right? For me, I'm pivoting into land development. There's going to be a huge opportunity right now going into the future to buy businesses.
Why would you ever lend outside of the policy when you had the means to put it into the policy?
To be honest with you guys, you're not building wealth by just getting a 12% return.
It's not the knowledge, it's the application of the knowledge that always matters. Welcome back, everybody. Another week, another wealth webinar. Thanks for joining us, where we're going to teach you how to take back control of your money by teaching you how to be the bank. And today we've got Mr. Chris Naugle joining Stephen and I, and we're going to be talking about a brand new deal he's got. You see, a lot of you that are on Private Money Club, many of you started lending to Chris Naugle, and then some of you got paid back the money that Chris Naugle was using. You were unhappy, and you're like, hey, does Chris have a new deal? He hasn't had any new deals lately. I literally have, I call them Chris Naugle junkies that want Chris Naugle deals, and he's just not had any. He switched most of his business from going to, flips. Now, most of his business is back to wholesale, but he's shifting back over into some development deals, much like what you see from the Fullers, and you see us talk about them all the time. But what I wanted to do is I want to just go back and forth, and I want to talk about some of the things that Stephen and I hear on some of the calls that we do and I want to hit specifically on the reasons people don't become their own bank, the things that people say are the reasons why they don't. And also I want to hit on some of the things that we've been seeing in the Facebook group. We do have an IBC, an Infinite Banking Concepts page. It's the biggest one on Facebook. There are, I think, 2 or 3 of them now, but ours is definitely the biggest. But I want to talk about some of the things I've been seeing on there too. So Stephen, you want to go rapid fire back and forth?
Yeah.
All right. Good. So I'll kick it off. One of the things, a lot of times that I get on phone calls is I'll be talking to somebody, we'll be explaining it. And a lot of times they say, well, why doesn't everybody do this? And I tell them the reasons. And then at the end of the call, they say, okay, well, I have to talk to my spouse, my significant other. And I usually say, okay, go ahead and talk to them. Here's the 90-minute video. Make sure they watch the video before you try to explain this to them. And a lot of times that never goes well. Now, in the comments, what I'd like to do is involve the audience. How many of you actually had something similar to that? And then I want to hear Stephen's stories on this. How many of you watched the video, saw us do the presentation, learned what the infinite banking concept was, and then went and tried to explain it to your significant other? What did you hear? How about you, Stephen? We'll let you kick it off. What are some of the things that you hear about?
Well, I mean, I would say like the biggest one is looking at infinite banking as an investment. When I see my money growing, I can have my money grow much better somewhere else. I hear that a lot.
Yeah. And how many of you have ever heard that? Leanne said, my son said it looks like a scam. I've heard that before. It sounds too good to be true. And it's always pretty interesting. Wife said, I'm confused still. Bob, did your wife watch the video? I guess would be the first thing.
Peter said, she said, why are you waking me up for this?
That's your first mistake. Let the woman sleep. I know you were excited. Oh my God. Why isn't everybody doing this? Yeah, we hear that all the time, and it's all, so many times when the people say, why isn't everybody doing this? They're the ones that don't end up doing it. It's interesting. And I'm not going to use any names, but I had a woman, I don't know, probably 6 months ago. She had come across this somewhere. I think I was on a podcast or I was on a training with somebody else. And she called me up and she had the perfect scenario. Literally, like if I could bottle up the perfect client for the infinite banking concept and some of the stuff we do, she was that. She had all the makings of everything. And you don't know this, but I've even trained on her policy design because it was so freaking good. She went through the entire process, got approved, and then at the tail end, said, my husband isn't really understanding this. And, I don't think he wants to go ahead and do this. And she then started like forgetting, what it was she wanted to do. And we revisited it numerous times. She didn't end up moving forward. And it's a shame, but you know what? I always tell people sometimes it's best for us to understand who our client is not so that we can then understand who our client is. And she just is not a good client, even though on paper, everything I talked to her about, perfect. Literally, it would have worked so freaking well that I would have a hard time duplicating that kind of a case study and that kind of success. But unfortunately, sometimes people, the old Will Rogers, people think the problem isn't what they don't know. It's what they think that they know that just ain't so. And her husband thought he knew what just wasn't so. So that's one thing. Stephen, let's have you talk about one that you've done.
I mean, I never really gave this some thought, but putting me on the spot here. But I mean, we have it a lot. Like I just recently had a client that came on and was very, very analytical. So, and this was actually working with another one of our money mentors. So we got on a Zoom call together, and he shares his screen and he has all of these spreadsheets built out where he took took his illustration and put it into the spreadsheets and was showing, over time on what happens. And the biggest disconnect for him was going back to what I was saying before with, looking at it, it's this or that. He wasn't taking into account that when he puts his money in there and then pulls it out to invest it or do something with it, it still remains all of it in there, compounding and growing. I think when we talk about uninterrupted compounding interest and how when you put your money in, it never stops compounding, I think that kind of glosses over a lot of times, and people don't realize that actually does happen, even when you're simultaneously using the money. And so I think it takes like several times, and I get that a lot on calls, like, oh, wow, like, are you sure? Like, that's really how it works? And then it goes back to a lot of the comments on here, like, well, that sounds too good to be true, or that sounds like a scam, or that, that this or that. So, I think it's because it's so powerful and it's such an unbelievable way that works. I think it's hard for people to grasp it. And that's why, like, when I do my presentation, I think when you do too, when we're introducing it for the first time to somebody, we do talk a lot about the mindset portion of it, because you really do have to shift your mindset and shift the way that you look at it to fully understand the power of this. And even then, just from my experience, people say they understand it, but they don't. And I know that because they start the policies, they put them in force, but it's several months later that I'll get an email being like, thank you so much. This is awesome. This is exactly everything you guys said it was. So I was like, well, no kidding. Isn't that why you started it? And they're like, well, no, like, I still didn't really believe you. I kind of took a leap of faith, but now that I'm actually doing it, like, hell yeah, I'm all in. Let's do more of it. So it's, that's probably what is the most for me, Chris, when I hear.
No, I love that. And when I was doing a lot of the calls myself, I'd hear that a lot. Well, I can make more money in the S&P. I can make more money in real estate. I said, I don't know what part of this you missed, but you can make money doing both at the same time. You don't have to pick one or the other. As Caleb's book, The And Asset, very simply puts, it's this and that, not this or that, because you put your money in the policy, then you take the money from the policy and you do the investment, and you're making money in both places, not just one. And I think that's a major misunderstanding. But once you understand that it's not too good to be true, it's the scam one's always interesting to me, because it's just stupid whole life designed a specific way for this process. But I love this one. Christy said, I talked to my brother-in-law. He said, I have been approached by Whole Life before, and it's an expensive life insurance policy. Who else says that a lot? How about Dave Ramsey? Doesn't he say that a lot? Dave Ramsey always says Whole Life is an overpriced, expensive life insurance, that he doesn't understand why anyone would buy it. And let me just kind of I want to say this one thing, and I should just go grab it and show you. When I first started in as an advisor, I have 2 whole life policies that are traditional off-the-shelf whole life policies. I mean, I could even say my broke ass self sold me those policies back when I was an early financial advisor, because, hey, I wanted coverage so that I could actually say, hey, I've got policies myself. But they're just regular New York life whole life policies. That was 2004. The first one was started. 2006, the second was started. So tell me this. How much do you think I take out of that policy? Either one of them. If I put $1 in, can anyone guess how much money I'm able to take out of the standard, overly priced, expensive piece of garbage whole lives? How much do you think? If I put $1 into either one of those, Peter's about right, $3. It's actually a little bit more. So the policy that was started in 2004, it's like $3.70 some cents. I have the most current statement right over there. But think about that. That's a regular whole life. So how can anyone sit there and say that this is an overpriced insurance policy when I put $1 in and take more than $3 out? Some people would say, yeah, but look at how long you had to wait. Yes, but that whole time I had to wait, guess what I was able to do? And guess what I did effectively? I used that money over and over and over again to do all the things that these people that say it's overpriced are doing with their money saying is better, like buying stocks or buying real estate or lending money to people on Private Money Club. I've done all that from those old whole life policies. So even though I get over $3 back for every dollar I put in, I've made money a second time the entire period of time. I mean, in the beginning, I used them to pay off debts. I mean, how much is your credit card debt? Over 20%. So think about that. Like I use these garbage whole life policies, as some people say, to pay off my debts. And I recaptured the amount that I used to pay the creditors. And that goes back into my policy. I mean, that's over 20%. In a financial advisor's wildest dreams, they could get 20% year over year, every year with no risk. But you can just pay off your credit cards using this system. Like, and it does that.
The other thing, Chris, like is people a lot of times I feel like try to make this more than what it is instead of just keeping it simple and remembering that the whole life portion of it is simply the vehicle. And it's the infinite banking concept, that process of moving money, the velocity of money is what makes it powerful. So people try and turn the vehicle into something more than what it is when there's no need to turn that vehicle into anything more. So a very simple way to look at it a lot of the times is, okay, so let's look at the alternative then. All right, so an alternative to this whole life policy is a checking account or even like a high yield savings account or something like that. Because all it is at the end of the day, it's a place to put your money. Like your dollars have to go somewhere. And so where do you want your dollars? So when you compare those, it's not even close. Like it's not even a comparison. And so I just feel like that's the other thing, is trying to make it more sometimes than what it really is at the end of the day. And just look at the, like, okay, is it this or that? Like what's better? Pros and cons of both. And a lot of times that will help kind of explain it to somebody that's newer.
And I love what Mark Perry said. He said, people tell me it's a poor investment. And Mark, anyone that ever tells you that it's a poor investment, say you're absolutely correct. Thank God you understand this, because it's not an investment. An investment involves risk. Look it up. Look the definition of investment up. An investment involves some level of risk. How much risk do you take by putting your money in a specially designed whole life? Zero. It's got stamped all over it. Guaranteed, guaranteed, guaranteed. There's no risk. So Mark, they're absolutely correct. You could congratulate them, pat them on the ass and say, man, you are so smart. I thought nobody understood this. Of course, it's a poor investment because it's not an investment. It's guaranteed. There's no risk at all. So, it's not, I don't know. It just, sometimes it just boggles my mind, and there's so many people that start the process with us and they never finish because somebody gets in their ear. But it's a brother-in-law, it's a significant other, it's a coworker, it's a financial advisor. Like they're notorious. Financial advisors, you would think, would understand this. They do not. Financial advisors do not understand the infinite banking concepts. And if you find one that does, you found a rare bird, literally, because they just don't, they're not taught this. I can prove it. I could go through all the advisory firms that I worked for, which I've only worked for 2, but all the other advisors in there, none of them understood what this was until I explained it. Even after I explained it, they didn't want to do it because the commission that paid out on it was 60 to 90% less than they're used to getting. So they're just back doing what they're doing. Or now they're out there trying to sell you an IUL, which is a whole another ball of wax that I don't feel like talking about here. Just because it's a long conversation. So Trey said, I love the stock market, but what I really love about the IBC policy is that when the market is bleeding red, I can pull a policy loan and invest in the S&P. When the market recovers, I can pull it back out and pay the loan off and keep the profit or leave it in the stock. You could even do that with the dividends on dividend paying stocks. You could just strip the dividends out, put it back in the policy and just rinse and repeat. But like what Trey just said is exactly how you should, when somebody says, oh, the stock market, oh, indexes, oh, this, oh, that, that's exactly it. Great. Trey does the exact same thing. He loves the stock market, but he uses his policy to buy more stock or, more of a position in the index. These are all great ways to use it. Now, before Chris comes on, I wanted to show you something. Craig and I are working with a really amazing client who does get this. We developed something that, pretty soon, and I'm going to call out Tess. We got Tess, we got Emily, we got a couple people behind the scenes, Craig, who are developing something that's going to be really, really cool for some of you, not all of you, but we're going to start with me because I desperately need the help. It's called D4. It's a full management of all of your infinite banking business so that you don't have to keep, you know, you don't have to keep track of everything. Now, I know our mapping team does a lot of this, but this is going to be a whole nother level. Think of it as our mapping team on steroids built for you. And that's why it's called D4, done for you. But I want to show you something here by sharing my screen. This is something we put together, and this will show you the flow. And I just want you to kind of just look at these numbers because this should blow you away. So you always hear us talk about this is how the money flows, right? Money goes into the policy, so your premium deposits, and that just comes from whatever your income bucket is. Could be W-2, could be 1099, maybe you sold a business, sold a piece of real estate, doesn't matter. You all know where your money comes from, and the savings portion goes into the specially designed whole life. Then from there, we try to, as quickly as possible, find a place for that money to go to work. In this case, we're just going to take a max loan, and then we're going to put that money in here. I just use Private Money Club. Okay, there's deals on Private Money Club every single day. They pay anywhere between, I don't know, 10, and I've seen them up as high as 20%. And then we take the income, the interest that we earn from Private Money Club, we roll that money back into the segregated bank account. For any of you that are kind of perplexed about the segregated account, all it is it's a bank account, like a checking account at your local bank that we use solely for your infinite banking business. Think of it as just books and records, or read the book Profit First. It's all the same. This is just a new bank account. So the interest comes in here, and then all we do is we pay the loan interest back to the policy. You could even pay more than the loan interest, but in this example, I just want to show just the loan interest going to work, because what we're going to do is we're going to continue to keep reinvesting the existing and new capital into more deals to keep diversifying. Or you could even diversify further. You could do some private loans, then you could do some S&P 500, then you could do some gold. You could, it doesn't matter. You could do whatever you want. We teach so many different ways. But now don't get hung up on the numbers, okay? This is a larger client doing bigger numbers. Take off a zero, take off 2 zeros. I don't care. Just follow the flow of the number, because even though these are bigger numbers, if they were smaller numbers, the mathematics behind this are identical. Can everybody understand that, right? So here we go. So 440 goes in. We're able to use 348,996 immediately. So what do? Well, we take 348, we lend it out. And this is a deal showing a Rob and Nicole Fuller with ROI Properties. We use them because they're pretty steady Eddie on Private Money Club. That interest that would come back is $37.81. So that comes back to the segregated account. Then from there, what we do, and here's the math. Okay, so from there, we take the gains, year one, reinvest, $25,476. Now, why $21,476? Because we paid loan interest of $19. Okay, so the first year was $45,000 that we made on that private loan. We paid $19,000 back to the insurance. This is what people don't like. People are like, oh yeah, but I got to pay interest to the insurance company. Yeah, but how much money did the insurance company pay you already? Well, I'll get to that in a second. So we're gonna give $19,000 of the $45,000 we made back to the insurance company in loan interest, and then we're going to take the remaining amount, the $25,000, and we're going to give that to another deal. We're going to lend it back out, but we're going to add another $381,500, which is the second year, because we put 440 in. Now we can take 381 out. 381 plus the 25 means now we've got a total of 755. What we're doing here is laddering. A lot of us that get into the infinite banking concept do this. We take our gains and we reinvest those gains, just like what you've done in your 401k. It's just like what you've done in your brokerage account. When you make money, where does the money go that you make? It reinvests in more shares or more, units or whatever it is you're investing in. Same thing here. When you're doing real estate, what do you do with the gains from the sale of a real estate deal? Most times you reinvest it in another real estate deal. That's just what we do here. So I don't want you to think this is anything different than what you're doing now. It's the same thing, just add a different name. This is being your own bank. So 755 is now working, and now you got 8190 coming in the second year. This is where the rubber meets the road, and this is where I don't care how much somebody doesn't want to believe the numbers. This is where you make them a believer. Let's hit the bad part. The first year, this client put $440,000 in and only had the ability to take 348 out. Right there, most people are like, oh, well, that sucks. If I put 440 in the bank, I could take 440 out. We have run the mathematics on this upside down, backwards, every which way you can. It always works, but it does take time to work. So I want to be very clear. For somebody that can't swallow the fact that if you put 440 in, you can't use all of it in the first year, this just isn't for you. Okay, so then we run the numbers. Okay, the loan principal is 348. 19,000 was the interest on the loan in the first year, which gave us a remaining cash value because we didn't take all the cash value out of 38,777. But here's the cool thing that no other vehicle on earth can do. And I've had some people try to tell me that they're margin accounts. Yeah, but I bet you any money you're getting pinched right now on your margin account because stock values are going down, which means you're probably getting pinched on the margin balance. There's margin calls. That doesn't happen here. If I put 440 in and I take a loan for 348, how much money's left? The difference. And how much money's earning interest? All of it. That's the thing. So I'm just showing you here, that's the 38,000. So we put that money into a PMC deal. So 348 is lent out. It earns $45,000, which is 3781. Okay. So that's how much money you'd make the first year. Now you'd make more if you put it into a bank account and just did the loan from the bank account. I'm being clear about that because here you lost 6%. But now the second year, now that you understand all the numbers, I'm just showing you the math. The second year we do 440, but now we can take 381 out. Okay, so the total loan is 730, and you can run the thing down. Now our cash flow is 8190 because we just keep making that money go to work. Now, second year, we only make 1.57%. Now, even some people would still say that that sucks. They're like, oh, you only made 1.57. Yeah, but you know who isn't going to say that that sucks? If something should happen to this person, they should die. Their family, I think the death benefit's like $8 or $9 million. Their family gets a tax-free check for $8 or $9 million. So when people say that that return sucks, I say, well, when you pass away and your family gets a check for $8 or $9 million, they're not going to think that that return sucked at all. Matter of fact, they're going to be so thankful for you and what you did and the planning you did. So that's the thing that you always got to understand. Well, let's keep going because here's where it starts getting good. This is only 3 years in. Remember, we gave up 2 years of pretty nominal returns, period. Year one, you lost. Year two, you made. How many of you have put money in the stock market and lost money the year you put money in the stock market? 100% of you, I bet. If any of you are older than 16, all of you have lost money in the stock market. But did you sit there and say, oh, the stock market just sucks because I lost money? No, you just sucked it up and you made money the next year. Same difference. But here, you got a death benefit. When the stock market lost money, did they give you a dum-dum sucker? Did they send you a letter, with a congratulatory, for being tough and staying in the game? None of that. You just lost money. Here, you got yourself a death benefit. Second year, 1.57. The third year, we just keep rinsing and repeating. Remember, we're never paying the loans back. Okay, we keep paying the interest on the loans right here. Third year, we pay $64,000 in interest, but we made 8.36% net of cost of insurance, net of policy loan interest, net. Fourth year, same thing, but we made 15%, then 22%. Shall I keep going? Because the numbers just get bigger. 6 years of doing this, you made 30%, and then 44, then 66, then 90, then 118, then 149, then 184, then 222, then 266. See, here's the problem. When you get to these kind of numbers, you know what people are saying? Oh, that's too good to be true. That never happens. There's the math. There's all the math right off of the illustrations. We even got little disclaimers on all these at the bottom saying all these numbers come right off of the policy illustration, except for, the numbers that we're lending. But who tells you that that sounds too good to be true when you tell them in the 8th year that you made 66%? Oh, how'd you make 66%? How is that even possible? Oh, it's a specially designed whole life. You probably wouldn't be interested. Well, yeah, I'm interested. Like, how did you make 66%? It's called this thing called compound interest. Albert Einstein talked about it. But I mean, look at these numbers. This is what you can expect. These are what's going to happen with yours too. But you've got to make your money work for you. And then we summarized it all here. And we just showed the cash on cash returns, year 5, 10, 15, 20, 25, 30. There's your death benefit, $8 million. There's your cash on cash return. 5 years in, you put 440 in. And how much money did you make? Well, you made $485,000. How many of you want to put $440,000 in something if you had 440, or just subtract a zero, 44,000 or 4,400? I don't care. How many of you want to make $485,000 on your 440 5 years in? And then after that, in the 10th year, you put 44 grand in because that's the most he can put in. And how much does he take out? Where is it? Right here, 193. Tell your friends that you're 10 years in. And you go to your friends at work that say, oh, that's a scam. Oh, that's too good to be true. And you say, yeah, I know. I just made my premium payments. You could even kid around, make them think that, it's terrible. I just made my premium payment of 44 grand. You put 44 grand in that stupid whole life. Yeah. And I just got my statement and I can take 193,000 out. And they say, oh, that's how much cash flow you have? No. I think you misunderstood. I put 44 in today. And as soon as my check clears, I can take 193,000 out. Yeah, just this year. No, next year it'll be more. And the year after that, it'll be a little bit more than that. And the year after it'll be more. You see, it can't ever go anywhere but up because it's just mathematics and it's guaranteed. Remember, it's not an investment because you were so smart to remember that. I think good for you, man. You remember this isn't an investment. It's guaranteed. At least the interest portion, the dividends are not. So folks, I just wanted to show this because sometimes when I'm talking to people, I just can't understand what part of this they don't understand. I get it. If the first year or 2 years are the only things you'd want, if that's only game you're playing or the first 2 years, this isn't for you. We got to know who our client is not so we know who our client is. Stephen, what do you think of that?
I love it, man. It's those are great. I was going to just email you and tell you to send me those slides.
Sure will. We're working on them. We're gonna make these slides and a lot of different things. And it looks like we got Mr. Chris Rude with us today. So, I talked to Chris Rude about this a lot. And, when we're talking about how to make your money work and your friends are all saying, oh, how do you make those kind of returns? Like you've been paying interest to lenders for, I don't even know how long, and you've never missed one. And you've never ever had any issues with paying them. Even if you've lost money, you've still paid, the lenders. And I think that's the part that people love about you. But I want to kind of I just summed it up because a lot of people are like, oh, how do you make 12% return? Well, you get to know someone like Chris Rude, or you get to know someone like the Fullers, or you get to know a lot of the people on Private Money Club. You build a relationship with them and you start doing business with them and you both win. And that's all there is to it. So Chris, I know it's been kind of, I'll call it a dry spell. Where you haven't really had a lot of deals for any of our Private Money Club members, but you've been, kind of switching gears and doing some things with the economy change. And I'd like to hit that. But now you're back at it and you've got some really cool things that you wanted to talk about. So I thought this would be a great platform. And I think this audience would love it. We got about 172 people here. So what I'm going to do is I'm just going to put it on speaker mode and just tell everybody a little bit about yourself, your business, what you think's coming in the markets and the economy, and how you plan to just literally crush it when everybody else is complaining.
Yeah, appreciate that, Chris. I think you've been, raising money for me now for probably, I would say, going on 4 years. And we've done hundreds of deals together, paid 12% interest, for the past 4 years. I can honestly say in the past 4 years, we probably only lost money on maybe 3 deals, but I've always paid the interest, and we've done hundreds. So, I mean, in the batting average world of in sports, if you looked at it in baseball terms, I mean, if I did say, let's just say I averaged, I don't know, 60 to 80 deals a year with you in the past 4 years, that's, a couple hundred, 200-300 deals, and only lost money on 3 out of say 300. I would say that's a pretty damn good batting average.
I like it. I think that's really good. Yeah. Babe Ruth, man, can you imagine what he would have done way better if he had a batting average like that?
Yeah, well, maybe we can call me Babe Rude. So in the real estate world, right?
Babe Rude. I like it, man. I like it. Yep. Your new nickname.
But yeah, I don't want to say I never lose because, I mean, the market pulled back in I think September, October of last year. And, deals that, we didn't necessarily overpaid, but we timed it wrong, pull back. I mean, and I say I lost money. I lost like $2,500 just getting out of the deal, right? We lost, I think maybe $5,000 on another deal. And then I did lose money on a mobile home park that I just wanted to get out of. But that's only 3 deals in the past 4 deals. But other than that, we've made millions of dollars in the past 4 years. So you just got to pivot with the times, right? And we're going into this new cycle. Things have definitely changed. We went from, flipping almost 80% of our deals and wholesaling 20. Now we've reversed that. We are wholesaling 80% of our deals and flipping only 20%. That's why a lot of you guys on Money Club probably said, hey, where's Chris Rude's deals? It's just, we're just playing a little bit more conservative game. And I'm looking for the next opportunity. And I think the next opportunity is going to be new build construction, because the market has, once COVID hit and inflation took off, investors took all their money and bought up everything, even if they overpaid because inflation was so high. and everything has been gobbled up for the most part. Not everything, but like vast majority of deals, this has been gobbled up, and it's not as easy to get deals anymore. So I think the opportunity going into the future is going to be new build construction, because they put a halt the past 2.5 years on construction. The demand for new housing is very strong, right? Very, very strong right now, but there's not a lot of inventory. So we're definitely still flipping houses. And you guys can post questions. If you have any questions, Chris can ask them as we're talking. Just more than welcome to interrupt me or whatever. But I think that the play going into the future is going to be with everything that's going on. You see a lot of migration to different states, which is pushing big time land development in certain states, right? Texas, Tennessee, Florida, hell, even where I live in Louisiana, land development's pretty big, because we have a lot of, people moving to the South from across the border, whether you like that or not. Illegal immigration's a real thing. We have millions of people running across the border that they need a place to live, right? And a lot of these people are hard workers, so they're going to get a job and they're going to buy something. So with that said, we're looking more into land, subdividing land, and either throwing some trailers on it, migration from blue states to red states. That's exactly right. That's what I meant when I say migration. I mean, the people that are moving from California, New York, New Jersey, Washington State to all these southern states is out. I mean, if you look at the numbers, it is astronomical, the amount of people. I mean, it's almost hard to mess up in Tennessee. I have a buddy that develops in Tennessee right now. He can't build houses fast enough. It's so crazy. But what we're going to start doing is we're going to start doing more land development, because the days of where we could buy 8 to 10 deals a month are kind of, I would say they're on hold for a little while because of the current economic condition we're in. So you got to pivot, right? You got to pivot. And for me, I'm pivoting into land development. The only thing I can still get really awesome deals on right now is land. Like, nobody's mailing land, right? So I do a ton of direct to seller marketing. We spend about 30 grand a month trying to find single family homes, apartments, mobile home parks. When I send out letters to people that have land, I mean, I might have a guy that calls me back and he's like, I never got a letter. I've been owning this property 45 years. I ain't never got a letter from somebody about wanting to buy it. This is a cool letter. So, but when I send out letters to buy an apartment, mobile home park, or single family home, that person probably got a letter the same month or the month before. You got to go where there's no competition, right? Yeah, you don't want to compete. If you haven't read the book, 0 to 1, great book, talks about this. Peter Thiel, this book right here. It's all about competition. Great book. Pick that up if you ever want to understand that, right? And Blue Ocean is another book. Is it Blue Ocean Strategy, Chris? You ever read that one too?
Got to fly to San Diego to be on a radio show, and that's the book I'm gonna read. I think I can get through it on the whole trip.
Yep, great book, 0 to 1. So a lot of people kind of downplay startups, but I mean, if you can start a startup where there's no competition, it's off to the races. And that's what I'm trying to get to you guys that are listening, is that land, undeveloped land, is uncharted territory as far as there's hardly any competition, right? Everybody's flipping houses. Everybody wants to get into flipping houses. I mean, you have a lot of competition, but if you go where there's no competition, you can kind of play the game at a high level and corner the market. So that's kind of what I'm doing, is that we're pivoting towards land development. And I wanted to get on here and kind of educate you guys on what I'm doing. We're sending out letters to people that have maybe been having land for, 30 to 50 years. Their grandparents probably gave it to them. They probably paid like $50 an acre. And we can pick it up for 10, 15, 20,000 an acre. And they think that, they're shitting in high cotton, so to speak. And you have to excuse my foul language. That's how I talk. If Chris knows I've been on here long enough, I curse and I swear sometimes. I apologize in advance. But that's where we're going to be playing. We're going to be buying land. We already got, right now, we have about 6 land deals going right now that we have to take through entitlement. And I wanted to have a conversation with all of you guys to see if that's what you guys wanted to do. If you guys want to come help me buy some of these properties, we have different options where we can pay a pref, or we can do, equity where you own the deal and make a bigger rip if you hold off on the prep, or we could do a combination of both. But I kind of wanted to see where you guys are at as far as, lending, because I don't want to bullshit a lot of people on here. We're probably not going to be flipping as many houses in this next cycle as we were the past, 6, 7, 8 years. So, and I'm buying this land at Grand Theft Auto. I got a piece of land right now on a major intersection for 55,000 an acre, and right down the road they just sold for 125,000 an acre. I bought it. I have it under contract right now for 50 cents on the dollar, and it's all frontage. It's 10.8 acres. I picked up for 55,000 an acre. So we have deals like that. We're gonna probably want to close on and raise the purchase price. I believe is around, what is that, 550,000. We'll probably want to raise about 700,000 on that deal, and we pay you a pref of 12%. We've got deals. I've got a big project in Gonzales, Louisiana for, we're buying 22 acres for 850,000, but we're going to need 2.5 total on that deal. I'm kind of looking like I'd want to have somebody come in as an equity partner. We're open to what you guys are willing to do. Because you're not, some of these deals we're trying to find partners versus paying pref, but if you prefer a pref and don't want to do that, we're open to that too. But if we can kick that pref down the road and give you more equity to where you make a bigger rip in exchange for not getting a pref, we're willing to give you a lot more equity in the deal to where you're an owner in the property and make a big rip at the end. So I think it's really up to you guys, but we're gonna have different options. That's right, preferred return. That's what a pref means. But if you guys have any questions, let me know. I'm still gonna have flip deals going. As a matter of fact, we have 2 flips coming up that I was gonna introduce into the Money Club. I'll give it to Chris for you guys to fund, but they're small deals. I think they're like, 60, 70, 80,000. That nothing that's going to be a lot of money. So let me see some of these questions coming through. What amount is the minimum, Chris, would entertain lenders contribute? A minimum, I would think, depending on a deal, I would say probably, Chris, what do you think? Probably 100,000, maybe minimum 50 to 100.
Like the Fullers are 100, but I think they miss out on a lot of people. Like, I know a lot of people in their self-directed IRAs have right around 50 grand. They can't do a deal with the Fullers, which I know you and, Rob know each other well. That's why I keep using them, because it's kind of, you guys are like 2 A-listers, I would say, on Private Money Club. But I think a lot of people wish they could get into the Fullers, but they can't because it's 100. So 50 would be a good number. I mean, we've done lower amounts for our private funds and had a lot of success at 25 to 50. 100, nothing wrong with that. It's just you rule out a lot of the folks that really would want to get in.
Yeah. I mean, if that's what it would take, I think 50 would probably work. If we have, maybe we got 10 people at 50 that you can raise $500,000. I think that could work, but.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
Guys, let me know if you have any questions too, because another thing too, I want to talk while I'm on here. Patty is in the middle. If you don't know Patty, Big Mama Rude, my wife, she is every bit of 115, 120 pounds. I call her Big Mama Rude. She's tiny, but she is getting her contractor's license right now. She loves to build. The house I live in now, she designed the house, 2 houses before that we built. She loves to design. So she's getting her contract. We're going to start doing new ground construction builds because I can find land for 50 cents on the dollar. I don't know if some of you guys have an appetite for new build construction, right? That might be something too we could pay prefs on. We're looking at land sites right now to start building some new construction. That can be something. In addition to that, there's going to be a huge opportunity right now going into the future to buy businesses. Baby boomers right now are the largest segment of people in the world, not just America, but in the world. That's the post-World War II. That's basically the World War II generation's children that they had. They are all starting to retire and go into nursing homes and die off. And they own the vast majority of the real estate and businesses in this country. And they are all starting to sell off at a discount. Chris and I were talking about, we don't want to get too deep in this because I know you guys may not want to be in this game, but I think it's worth mentioning. There could be some opportunities going in the future where you can invest in some businesses, especially if they own the real estate that they sit under. That way it would be protected. You'd have a protected interest and you can own a piece of a real estate. That's right. Born from 1946, 1964. And they own this comprises the vast majority of the wealth of America. And they have to sell. And guess what? A lot of their kids do not want to own those small businesses. I'm talking about HVAC companies, septic tank companies, a plumbing company or landscape or contract and construction. I mean, you name it. I mean, a lot of these guys own most of the businesses in America and maybe they do, 2 to 5, $1 to $3 million in revenue. And they make great money that we're looking to accumulate businesses also that are symbiotic or virtually integrated into what we're already doing in real estate. Like we spend over $100,000 in HVAC every year. So we want to target some HVAC companies. That might be another opportunity. I'm going to start presenting all these opportunities to see how, because I'm telling you guys that this I missed the boat in 2008. And I think Chris missed the boat in 2008, 9. Also, we were too young. You know, I was in my in my mid 20s. I think I was 25. I didn't have the wherewithal to know what was going on when the shit was hitting the fan and everybody was shitting the bed. I mean, if I would have known what I know now, and I could have raised private money, and I had access to guys like you who you know have some capital, who trust me and know that I'm a good operator, I would be worth hundreds of millions of dollars today. I just didn't know what I didn't know, and I do not want to miss this opportunity again to be able to capture deals and the amount of transfer of wealth that's going to happen probably over the next 2 to 4 years is going to be astronomical, especially with everything that's going on with, I mean, look, how many of you guys know Ray Dalio, read any of his books? So Ray Dalio talked about, you know, a lot of this stuff right now that's going on in the economy with cycles, and, you know, there's going to be a huge disruption, whether we like that or not because he says so, but because that's what history tells us. We have a waning dollar, right? The dollar is kind of at its end. We have a new emerging power, which is China. And we have one of the biggest political divides in America. And he even goes to the extent that he said a year ago that, hey, we have a 30% chance of having a civil war in this country. Now he upped that to 50%.
Just saw that. That's frightening, man.
That's
one
scary.
thing I hope that I'd never have to live through. You know,
yes.
I don't want to live through stagflation, and I certainly don't want to live through a civil war.
No, you have a civil war. You think the economy's bad? Listen, people ain't going to the store. People ain't going shopping. People ain't spending money. They're just trying to figure out how to stay alive, right? So you have to pay attention to politics. A lot of people I circle with say, well, why you talk about politics so much? That doesn't matter. You know, as business owners, we don't pay attention to that. That's absolute horseshit. You know, if you don't pay attention to politics, it can, you know, kick you in the nuts. So with that said, Ray Dalio says something I'll never forget. And it leads up to this, why I'm bringing up his names. He says, if you're paranoid and you're worried, you ain't got to worry. He says, if you ain't worried about it and you ain't paranoid, you should probably worry. And I think for guys like me and Chris, and probably a large percentage of you guys on here, you probably worry about all this stuff because you're aware and you have a cognitive awareness to know that, okay, something ain't right. But that also breeds opportunity, right? Anytime you have a crisis, I think the old Chinese saying that, you know, derivative or something to do with crisis equals opportunity, right? And if you understand that and you can position yourself to get into a place where you can capture opportunities, because the most opportunities is in times of crisis, right? Not when times are good. Everybody's happy. Everybody's, you know, has confidence in the marketplace. And there's another guy named Doug Casey. He wrote a book called Crisis Investing. I mean, you know, you ever heard of Doug Casey, Chris?
I have not.
Yeah. He wrote a book called Crisis Investing, really good book. And he built most of his wealth from that. I mean, it kind of sounds bad. It's like, you sound like an ambulance chaser, right? But that's where the opportunity is at. I mean, Warren Buffett says it also that, you know, you got to be fearful when people are greedy and greedy when people are fearful, right? And that's where I'm going to be. So I just want to be in a position where you guys can come with me. We're going to start buying up land. We're going to start posting the exact amounts here, probably in the next week or two, in Money Club, for people that want to be in the land development. And look, and I try to, you know, be worst case scenario with you guys. If I'm on your side, how am I protected, right? We're buying this land for 50 cents on the dollar. I mean, Chris knows, like, you've seen the deals we buy. If I can't steal it legally, morally, and ethically, I do not buy properties or even businesses. And that protects me and you. I'll play worst case scenario game. If we have a civil war, that's probably worst case scenario. And I can't pay you guys a 12% interest. And I got to give back this property. I want to make sure I give back the property, and you even make more money than me paying you a pref because you got back a property that I bought it at 50 cents on the dollar. That's how my mind thinks. I double hedge myself, because you make money when you buy, not when you sell. And everything we buy is at Grand Theft Auto prices. That's how I operate. And that's how I protect you. That's how I protect me. That's how I protect my family. And I want to make sure that if it doesn't work out, that worst possible case scenario, you guys can still get paid by acquiring back the property. Now, I don't ever want to give back the property, but that's how my mind thinks. So who here would be interested in investing in some of our land deals? We got a few, Chris.
I told you that was going to happen, though. I mean, I can't tell you how many people I have literally notes on my desk still. I told everybody I wasn't going to do the post-its, but I got people that are like waiting for your deals. You know, I got Lisa waiting for your deals, and now all these folks are interested in your deals. And it's because you've built a reputation. And I mean, that's the thing. I mean, you've gone through the cycles. You've proven that you're a good investor. You've proven you're a good borrower, and you've never screwed anybody. You've never not made a payment, even in deals that you've lost money. And I commend you on that. I've done the same thing, and it's not easy. When you lose money on a deal and you still got to reach into your pocket and pay your investors so they don't realize anything happened, like that's why you're seeing this.
Yeah. So we've got quite a few. Okay, so good. We got people that want to invest in these land deals. Who here would want to be an owner of a small business and be a private money lender, but actually be an owner and take equity in a business? If I were to acquire a great deal in a service-based business, I mean, look, guys, it's great I want to kind of reiterate to you guys, it's great to get a preferred rate of return, right? That's great. That's building up your fast money. And I talk about this with my coaching clients and all my students, that you got to have fast money, medium money, and slow money. I'm telling you right now, getting 12% interest is great, and you're going to build up your fast money. It's good. But guess what? You have to get into another deal to keep that money going. You want to balance yourself. If you guys could be an owner of a company and put up some of the money for me to buy it, that's how you're going to build wealth, because you're going to have money for here on out. It's not like just a one and done where once I cash out, you have to look for another deal. So I want to leave my options open, because we're going to be acquiring businesses. And it's not like, I know you guys know me for real estate, but I came up through small businesses, right? I've started probably a half a dozen small businesses out of the back of my truck that we have taken to 7 figures, right? Oil change, mechanic shops, wholesaling, you name it. I'm starting a junk removal business right now. So if you guys are interested in that, I'm going to start raising money in addition to the land and flips, because we do have some more flips, but we want to start taking over. So, and Chris, correct me if wrong, but I mean, I had read an article that private money is investing into real estate, and they're becoming millionaires, but private equity is where where you take it to the next level and acquire businesses.
100%. Yeah. I mean, that's the next level. I mean, we've talked about it a little bit, and that's how you go from like a fixed income, right? Because lending money on real estate to the fixed income. And then, we had one other person, Justin, we had him on, and he talked about a big opportunity. And I think some folks went into that. I'm not really certain, but that's like that big payday someday. And that's what investing in business is, the big payday someday. I mean, Johnny Ive, with Apple, I mean, you could look at any of them. I mean, that's how they became stupid wealthy. They were wealthy, but that's how they became stupid wealthy, is they put their money into a business, not just lending money. So there's two sides. I particularly like lending, but I just like slow and steady.
Yeah, I think there should be a combination of both. But I think for us, I apply the same metrics when I'm buying a piece of real estate from a motivated seller. There's a lot of motivated business owners out there that have great businesses that are just old. They're 68, but their kids don't want it, and they've never marketed a day in their life, but they built a great book of business just on their brand and goodwill, but they don't understand marketing and sales. And if you can pick up that business, sometimes you pick it up owner finance or through an SBA loan, and you just put in some simple processes and systems and marketing with a sales cycle, you can double that business and create that value add. No different than when you buy a distressed piece of property and you fix up the floors, you paint it, you put a new roof and AC, and you create that value add. There's no difference in that when you buy in a business. So I wanted to make sure we talk about that, because there's going to be an opportunity coming here soon where I'm going to probably present to Money Club, and because land and real estate, I'm always going to do that. I've got that nailed. That's pretty easy for me. I can honestly feel like I could do that with my hands tied. We've been doing that for so long, but I know for us going into the future, I think buying small businesses is going to be a great opportunity for you guys to get into some equity and own a piece of the action, to where eventually one day, hey, we wrap it up, we can sell it, and you can actually build wealth, because you're not building, to be honest with you guys, you're not building wealth by just getting a 12% return. You're getting fast money, cash to pay your bills. Wealth is created by buying and holding either real estate or business assets over a duration of time. That's how you're going to build wealth. So I'm going to get with you guys here soon and with Chris, and we're going to start looking at, I'm going to put a deal together. I've got 2 or 3 deals right now. I want to figure out which one's going to be the best. How many of you guys, let me get a show of hands. How many of you guys would be willing and to be a owner in a land development deal versus just getting a pref and getting more equity in it and making more money, but not getting a pref long term? Raise your hand if you would be willing to maybe hold out for a year and then own, say, maybe 30 to 40% of a property, of a land development deal that makes $1 million, and then get a big swing and maybe make $300,000-$400,000 at the end. We do have people that would. So you got, and what I mean by that, you guys are willing to kick the can down the road, because the problem with land development is it's a process. It'll take a year, sometimes a year and a half between the time we start it, get it through entitlement, get the engineering work done, and then we start building out the roads and infrastructure, and we sell it all off. And some of these deals are pre-sold. That's a long. So if we don't have to pay a pref and we can give you guys equity and hold out, and you're going to actually own the property, you're going to be first in position, you'll get a bigger payout at the end for not taking a pref monthly versus holding out long term. So Chris, we had about 15, 20 people that'd be interested in doing that.
Yeah, I think so. So anybody that's interested, when you email Andrew, because I'm just creating a list for you, Chris.
Yeah.
When you email Andrew at chrisnaugle.com, make sure you tell him what you're interested in. Are you interested in the pref return of 12%? Are you interested in the business deals? Or are you interested in the land development equity deals? So just try to be specific about that. I'll put that up there again in case any of you need it. There's his email. So anybody that's interested, just email Andrew and just tell him what it is you're interested in. And then we'll get that all over to Jan and to Chris, and they can start, calling you and talking to you about it.
And I think, let's just say you have $100,000. Maybe you do a little combination of both. Take 50 grand and do it with a pref, so you can get your 12%, you can get your fast money going, and take your other 50,000 and invest it into a land development deal, or invest it into a small business where you actually own equity in the business, and you get cash flow forever. Or maybe you get a big rip if we sell that business in, say, 2 to 5 years. So be specific when you're emailing Chris or Andrew about what you want to do. But if I got a couple 100,000 or even, 100,000, you want to spread out your risk and spread and kind of blend your returns, meaning you want a preferred versus an equity. And I would blend the two. I wouldn't just go all preferred or all equity. I think that's the smartest and highest, best use of your money. That way it's growing, not just, from an equity standpoint, but you're getting a pref too. What do you say, Chris?
Yeah, I think that's a good idea. It's diversification at its finest.
Yeah. But I think that's about all I have for you guys right now. But I think and look, the businesses that we're going to be investing into are going to be sustainable businesses. I'm not going by a sea-doo shop or a boat shop or a four-wheeler shop right now, right? That's luxuries. I'm talking about businesses that are ugly and stinky, right? HVAC, septic, plumbing, landscape, mechanic shops. I just opened junk removal. Businesses that you have to have going into this cycle. Things that there's no way that it's going to get disrupted. People are going to pay their HVAC bill before they pay their mortgage, right? And then as far as the land development, we're only buying deals in great areas that we're picking up for like 50 to 70 cents on the dollar. That way if something happens, we have a freaking nuclear war, well, at least we bought the property at 50 to 60 cents on the dollar, and we can't pay you anything. You're going to own that property, and you're going to have a phenomenal equity position. Not that I'd want to do that, but I'm just telling you, that's how my mind thinks to protect you guys.
Love it. Well, here, let's hit some of these questions real quick. Eve said, and there's a couple questions from Eve. She's been kind of commenting in the chats a lot. You've probably seen it. She said she's still confused by the 2 different investment options. We kind of have 3 now. So 2 went to 3. Part owner sounds awesome. Are you open to more than one investor for a deal? Like you said, 50,000 each. And if so, are all investors first position? That's a great question.
Yeah. So all the investors are first position. You're going to own the property and/or the business that we acquire. The business that we were looking to acquire, we're going to try to figure out some kind of equity to hold on to our assets, like either whether it's equipment, or it's the land. Maybe they have an office and they own the land. We're going to try to figure out something. What was the second part of that question, Chris? They do.
Yeah, second part was basically asking, well, I think you got it. They were talking about what are the deals, and can there be more than one investor, and can you do, I think you hit them all. And then
Yeah.
the second part of it was how long do you borrow for? 6 months, 1 year, 2 years?
I would say for, a land development deal, it's going to be minimum 6 months, but probably a year to maybe even a year and a half on the land development. On my flips, I mean, I'm typically out of my flips within 3 to 6 months for you guys that have lent. Is anybody on here that's lent to me on flips on here? Okay. Yeah. So, it's sometimes, I mean, shit, I've even gotten out in 30 days before. Chris, I think I paid you like in 18 days.
It was like 18 days. I remember that one, man.
But I mean, they're typically probably 2 to 4 months on the flips. And then on businesses, we'd probably borrow you money for probably, I would say about a year, 6 months to a year. And then what we do is just refi with because there's a lot of owner finance opportunities right now. You can buy these businesses and the bank, the owners will finance them if you just put the money down. Then we build the books up, get the revenue up, and then we get an SBA loan, and then we can cash you out, and you'd still retain equity in the business.
Really big thing right now.
Yep.
All right. Let's see. What markets you work in?
Mostly it's just the South, right? Anything in south of the old Mason-Dixon line, the old Civil War line, Texas, Tennessee, Louisiana, Alabama, Florida, just follow the migration, right? That's what I'm doing. All these, and then if for instance, I'm in Louisiana, it's not exactly the best state as far as, economic development or people moving in here. Where I live is actually, Lafayette is the only city in all of Louisiana that's gaining population because it's a ritzy low city. So if I'm not in a high-end southern state, then I make sure the city that inside of that state has got to be a growing city. And we pay attention to all that. We Google that. We make sure because really, honestly, especially with land development, all you got to do is just look at the migration patterns. Is that city growing? Is it not growing? Andrew Chestnut's calling me right now. Probably already gets people blowing up his phone about wanting to do deals because he's trying to call me.
He's like, well, what's going on here? My emails.
No, I kind of threw him under the bus because he did this for us before. As he was kind of serving as transaction coordinator between your deals and Private Money Club. And when I said that, I was just like, all right, we got to give somewhere for people to send their info for these deals. So I just took a snapshot of it and I sent it to Andrew. He was down for the cause, but I don't think he knows you're on the wealth webinar.
Yeah, you guys must be already hitting them up, so that's a good sign. But anyway, that's what we pay attention to. We do all the market research. We make sure that, the cities that we're investing in are growing, and even the businesses of the cities we're buying in, that they're growing, and that they're not losing population. And that's kind of how we make a decision if we're going to invest there.
David said, what terms generally do you have and what is your ROI? I think we already covered that one. It was 12% pref, or you can
12% pref. Yeah, equity, I would, it's going to be a blend of say probably 20 to 40% equity. Let's just say we do a big land deal. The bigger the deal, would probably give more money because it's a longer wait. The smaller land development deals, you're probably only going to get maybe 20 to 25% equity if you don't want to do the pref. On the bigger ones that, maybe we need $2.5 million. Like I got one right now in Gonzales, Louisiana, which is a great deal. We're going to need $850,000 for purchase price. And then I think the total all-in investment after we put in infrastructure is $2.5 million. So what is 2.5 minus 850,000? That gives you our construction cost. But a deal like that, we're going to probably give more in the 35 to 40% equity if you don't take a pref. We're going to make our projected profit on that on the low end is 900 to $1 million, high end 1.3 million, but we're going to probably fall average 1.1 to $1.2 million profit in the next 12 to 18 months profit. So you can hold off and make a big rip, and because you're taking more risk, or you can do the pref. It's just we're trying to, if we're going to do a pref, we're going to probably start off with a smaller land development deal, maybe a $500 to $1 million deal, because we're not trying to have if we got too many of these deals going and we're paying, say we got four $2.5 million deals, that's $25,000 in prefs per month per deal. That's $100,000 in interest payments a month. I'm not trying to, kill myself at once. So we're gonna have to do this slow and steady and on a smaller scale to where it doesn't overwhelm me and my operators.
How does one find, Stephen, this is for you. How does one find one of those specially designed whole lives? I don't know. Stephen, you got anybody that does those?
Yeah, Cindy, we can help you. Just email me and I'll get you connected with the right people. I think I might know somebody. I'll put my email.
If you want to just send her your contact in the Q&A. James Davidson said, on a land deal, is there depreciation that will show up on a K1? Is there any tax benefit we will receive as we wait for the eventual sale and equity return?
Well, if I was a CPA, I'd better answer that question, but I'm a real estate investor and entrepreneur. I don't know about raw land, how that works, because we're putting in infrastructure about depreciation. But I mean, I know if you hold it over a year, it's taxed at a lower rate, which most of these deals we're going to hold right past a year. That's usually when we start selling off everything about a year and a quarter. So I would get with my CPA, but I do think there's some benefits to it. I just don't know the exact. Maybe somebody else can answer that. I'm not. I don't want to pretend to be an expert at that.
Well, James, he is a CPA, so I think he probably knows. But basically, in other words, if they're JVing with you and they're partnering with you, are they being brought into the entity? So then, if they are, then definitely they would
absolutely.
be able to
when we create the LLC and the operating agreement, you own that portion of the LLC. Let's say I give you 30-40%. You're on the operating agreement, and the LLC is owning 30 to 40% of that LLC and operating agreement as far as the profits, right?
So but not definitely yes.
Yeah.
So James, you're asking about your own deals, and the thing I would say, and this is James Irvine, sorry. Put those deals on privatemoneyclub.com. This wouldn't be the platform for us to talk about your deals since we're talking about Chris's deals, but happy to help. Just we'll type in there Private Money Club. You can post your deals in the forum or put your deals in the deal page if you're a premier member. James, so here you go. Here's the answer. James James Davidson said, land is not depreciable, but of course you will capitalize and depreciate the infrastructure. Just wondering if he was missing some benefit. So there's the answer.
Yep. And just remember, guys, so we got four different opportunities here. We still have some flips, not very as many as we did. We got the land development, then we have new build construction, and then we have business opportunities. Those are the 4 opportunities, whatever you're most like. So for instance, I have a partner in Tennessee right now who's a big developer and contractor. He can't build houses fast enough. So we just partnered up out there, and I'm starting to do my direct-to-seller marketing to find off-market land right outside of Nashville. There's so many people moving outside of Nashville right now. So if you are interested in that also, you just have to kind of pick your poison as far as what investments you want to be in. And understand the differences that, because new build construction, if it's a smaller spec house, take 4 to 6 months. We can pay you a pref on that. Flips are usually 2 to 4 months, and I'm out of those. Land development is going to be a longer play. You guys got to be willing to hold out. If you're not doing the pref and you want to own equity and make a bigger rip, you just got to be willing to hold for a year and a half. And in the businesses, that typically in a business, we're going to be paying, if you own, say, 20 to 30% of that company, I'm not buying a business unless it's cash flow day one. So that's going to be money day one. So let's just say it made $10,000, you own 20% of that company, you get a $2,000 check, right? So you got to understand the differences in these different opportunities. They're all different. Does that make sense?
Makes perfect sense. All right, Chris. Well, I know Andrew's taking care of that. So if any of you are interested, I'd put that up there one more time. It's Andrew at chrisnaugle.com. He's making a list, checking it twice, and then he's already calling Chris rude. So as soon as he hangs up, I'm sure Chris will be on the phone with Andrew, and then they'll start setting up calls with all of you. So Chris, thanks so much for coming on. And it's about time you got your ass in gear and got some deals for this group.
Yeah, man, I'm ready to get after it now. I think the panic of the high interest rates is kind of over, because I don't think we have high interest rates, guys. I think we all got high on low interest rates.
That's the right way to say it.
We interest rates are not historically high. We just got high on low interest rates. I bought my first spec house in 2003. My interest rate was 6.25%, and that was super low. That was like awesome rates. And now we're at 6.25%, 6.5%, 7% right now. And people are freaking out like, oh my God, it's in the world. When I grew up in my first house in the 80s, my dad bought his first house at 17% interest. We got to get real with ourselves. This is the new normal. We just got to get real with ourselves as far as, I think the market has readjusted, and now people are, okay, well, it's not the end of the world. I can't buy a house at 2.8% no more. But people still need a place to live, and people still got to go and buy property. So I think we're back to business as usual.
I couldn't agree more.
Yeah.
Awesome. Well, hey, Chris, thanks so much for coming on. I'm going to talk to him about a couple other strategies that play right into what you're doing. And we'll touch base and see how you did.
Touch base with me later.
I will.
Yeah, Chris, touch base with me later, and we'll get it knocked out.
Awesome. Thanks so much.
All right, brother. Appreciate you.
All right.
Take care.
One thing Stephen and I want to do, kind of wrap up the last 15 minutes of this, is, I want to show you something I've been doing. It's not something that you'll ever really hear me so much teaching about or or training, but it's something I thought was worthwhile and something I think could be beneficial to some of you, because like what Chris just said, we got high on low interest rates. So the thing that I think a lot of people miss, we hear this all the time, you know, they've got a car loan that's 3%. They got a mortgage that's, you know, 3 or 4%. And they're like, oh, you know, I don't ever want to get rid of this mortgage. But the thing that most people are missing is the velocity of interest. Stephen, if you get a lot of people saying that to you?
Yeah, I do. Yes, absolutely.
So I just wanted to show something, and I want to kind of wrap it up with just a few things like this. So I'm going to share my screen here real quick, and I want to just show you, and we do this in our trainings, folks. We teach this in the 90-minute video. I don't know. Let's just do, I'm just going to use the numbers they put up. You got a $425,000 mortgage, 85,000 was put down, 30%. I mean, we can do any, here, I'll take us back to the good old days. We'll just do 3.5%. So all I want you to do is I want you to kind of look here. That'd be an $1,800 a month payment. Now, yeah, let's get rid of the HOA. We'll get rid of all these. So we'll just do principal and interest. So 1526. Now, a lot of people would be like, that's a great interest rate. That's an amazing interest rate. And, you know, let's say you were lucky enough to get one of those 2.8% interest rates. And, you know, now you're like, holy cow, I'm never getting rid of this. And look at it, pops it up saying, oh, you need a 740 plus. You can't get this interest rate anymore, but we'll just stick it at $1,433. I know all of you would agree that that's a great interest rate. And most of you would look at that and you'd be like, oh my God, I would never use my policies to pay that off. But I would disagree. I would completely disagree. And if I can get the amortization schedule here, then I will prove to you why. I want you to look at this right here. Principal paid, interest paid. I want you to focus on that. Interest paid, loan balance 239. Principal paid, interest paid, loan balance. Okay, so here's the loan, 340. Total interest paid on this mortgage over 30 years is $176,000. You know, but some people would be like, yeah, it's just because it's a long period of time. So you paid for that 340 or for that $425,000 house, you paid 516. Here's what I really want you to focus on. Okay, and we can break it up and do every single month, but look at this. Here's your principal, here's your interest, okay, for 2023. So we'll just do it year by year. Principal, interest. What part of that do you guys hone in on? Do you hone in on still the low monthly payment, you know, which was whatever it was, like pretty inexpensive monthly payment? Or are you honed in now that you gave $4,200 in interest and only $2,900 went to principal? Because that's what I'm looking at. It's called the velocity of money. So based on that print, and we can keep going 10 and 14, 17 and 24. I mean, you can keep looking at it, but I want to show you something that I'm starting to do because I've run the math on it. So with the infinite banking concept, a lot of times people are thinking or wondering, how can I make my money work for me? And what different things can I do? And how do I reduce risk? I'm all about reducing risk. Okay, so I've got my policies here and I've got lots of stuff. You know, I've lent my money out. So this is the loan. Remember, I always show this as a circle. Okay, this is where your money starts, your W-2, your 1099 income. All flows down, not all of it, but the savings portion of your income goes to the whole life. We immediately try to find an opportunity for where that money can go. We take a loan from the policy so that our money continues to earn interest. And then things like this, and I'll just write the things that I've done. I've lent to Rude. Right now, I lend a lot to the Fullers. Okay, that's my number one. I've done stocks in the past. I don't have any stocks right now. You know, I have treasuries. So I've got all sorts of stuff, but here's something I've started doing. I started looking at all my mortgages on the couple rentals that I have left. And I don't have a ton of rentals left, but I have a few. And some of them, you know, I paid the principal down a little bit. So based on what it's worth and what I owe, you know, I started looking at it and I started looking at the monthly payments. Now, here's the thing. Any of you that own rentals or own anything that you did a commercial mortgage on, they always have a balloon, right? Like a interest lock. Mine were 5 to 7 years. So what got me thinking about this is almost all my early mortgages that me and Larissa did, they're all starting to balloon. They're starting to get to that point where now I got to refinance. And now I got to refinance. The interest rates literally on these refinances are like 7% right now. And I started thinking about this and I started saying, why would I give the bank 7% when I could give myself 7%? I mean, I've got policies that I put $1 in and I take $3.80 out of, okay? Older policies. All my policies are doing pretty well. So it wouldn't matter if it was 7% or 6% or 3%. I'm still making money. So what I've started doing, and I just started this, is I started looking at all these rental mortgages that I have out there. Okay. And I started saying, okay, I can take a loan from my policy and I can pay this mortgage off. Then the mortgage is no longer owed to Alden State Bank, but that payment might have been, let's just say $750 on one of the small rentals. I then get to put $750 a month back into my policy. Okay. So that's number one. And then I'll pay off another one. I got one right now that I think is like 20, gosh, I think it's like 2,500 a month. So I'm paying that one off right now. Me and the bookkeeper just talked about it. I got to talk to Tess about this, but I want to pay this mortgage off. And then that'll give me another 2,500 a month coming back to my policies. The money is already in my policies because I'm constantly recycling and recapturing. So I take that money out and I start paying off and literally becoming the bank on my own rentals. And then all I do is I just figure out what interest rate was I paying the bank. Well, one of them I might have been paying 5.5, which was this small one that I already did for $750. Okay. Another one might be, a refinance at 7%. So then I'm getting 7% here. Okay. This one I'm getting 5.5%. Now, a lot of people would be like, why would you, let's just say this one was only, they're not, but let's just say it was 4, but it cost me 5% to borrow money from the insurance company. Here's the thing that people would say, why would you pay off a loan that's only 4 with a loan that cost you 5 from the insurance company? It's so simple. I just showed you the math. This loan that I paid off, if it was 4%, I'm making this up, okay? If this loan was 4%, this is an amortized loan where all the velocity of interest is paid in the early years. Why wouldn't I want that? Okay, this loan is simple interest. I demonstrated that earlier in that example that I gave with the $440,000 policy. So I don't care if I'm paying 5 and paying off 4, it's the type of interest that you got to look at. I want to take back the velocity of the interest I'm being charged. It's never been about, to the banks, it's never been about the interest rate. It's been about the velocity of money. That's what banks understand well. And I just want to, now that you understand what I'm saying, I just want to show this to you again. This is how you're losing to the velocity of interest right here. These are your mortgages. For the first 8 years, you're paying more in interest than you are in principal. And to some tune, 85% of the money you're paying is all interest. Like, look at this, $850 to interest, $583 to principal. And it just keeps going. You go to 2024, same thing. Look at the interest versus the principal. 2025, interest principal. 2026, interest principal. See how it doesn't flip. Interest principal. There we go. I mean, I'm now 2028 and I'm still paying more in interest than I am in principal. So if you're really thinking about this, why would you not want to take back control of this interest that you're giving to the bank regardless of the interest rate that you're paying? That's just how you got to look at things. And then, I mean, let's just go back to this. And then I want to hit a couple of questions. I want to show you what I started with in the beginning, the flow of money. If you remember that example that I showed you in the beginning, year 1, we put money in, we take it out, we put that money to work. In this example, I was showing a deal on Private Money Club. I was kind of getting you ready for the Chris Rude deals because I knew they were 12%. So we do that. But here, what if I'm just paying off my mortgages and recapturing it? Year 2, doing the same thing. Year 3, 4, 5, doing the same thing. But you see here, like I described earlier, I'm making more than what I'm putting in. So my returns, sorry, I'm scrolling fast. So year 5, I put 440 in, I take 485 out. And here, actually, I got a better one. Here's year 1 through 10. So where's my break even? I put 440 in the 3rd year, I take 443 out. So it took me 3 years to break even. Okay, where I'm taking more out than I'm putting in, but I still had a high percentage to use. And then every year thereafter, I take more out than what I put in. 100%, a little more than 100% of what I put in, 105% of what I put in, 110% of what I put in, plus the velocity of interest from paying off those mortgages. This is what we try to teach every single week. This is what the infinite banking concept does. I mean, it just allows you a way to take back control of your money. And as Nelson Nash said, the infinite banking concept is nothing more than taking back the banking functions in your life. What I just described on the screen is taking back the banking functions in your life. Why would I want the bank to have a mortgage when I could have that same mortgage on my books and I could make the same monthly payments, but I get that interest in principal. Like, why am I cheating my family and helping the bank, make money? I want to be the bank. So I got to start practicing more of what I preach. So I'm going to pay everything off. All the lines of credit, I'm going to pay them all off. All the mortgages, I'm going to pay them all off. It'll take time, but I'm going to do it. And I would suggest all of you set the plan in place with us to do exactly the same thing. Now, I know, like Chris Rude and Fuller's and all those opportunities, they're all there, but also never, ever take your eye off the closest, safest money you can make. And that is just by looking at your budget, looking at your personal balance sheet. Who are you making payments to every single month? And if it doesn't have your name on it as your bank, you're making payments to the wrong people. Take back the banking functions in your life, folks. That's how powerful this is. And it always starts with the smallest balance and goes to the biggest balance. That's the easiest way to do it, the snowball effect. Anything you got to say on that, Stephen?
Yeah, just email me to get started. Let's get you guys going. It's a beautiful thing. I got an actually, I was just reading. I have a exam tomorrow morning at 8 a.m. So I just was texting my wife, we got to eat healthy tonight and, can't drink coffee or anything in the morning. So
awesome. What's the exam for?
It's for a new policy.
Oh, yeah. Especially after 4th of July, you drink all those beers, you got to flush the system. Lots of water, Stephen, lots of water.
I know. It's the only time they could do it though. So I was like, all right, I'll make it happen. But yeah, so hopefully I get a good rating.
Yeah, no cigars either. That's an important one. They get you on that. Yeah, so somebody's asking, will I share the mortgage calculator? Sure, it's just bankrate.com. So I'm going to put that here. I'll just put it right in the chat because a lot of people probably want to know what that calculator was. It's one I use all the time. And then JP Johnson said, is the flow of money detail analysis available to current policyholders? Yes. So JP, I think you're talking about like our cash flow models that we create for our clients. All you do is if you're with us, you just ask the mapping specialist. So we definitely can create a detailed money, any type of analysis you want within parameters. As long as you're a client of ours, we will create that through the mapping team. So you definitely can get a hold of whoever your mapping specialist is. If you don't know and you missed all the emails that we send on who your mapping specialist is, I'm just going to give you the head of the mapping team.
Yeah, and they've had some changes lately, so it might be someone new, but
that's true.
Take care of you.
So there you go. Just send him an email and he'll tell you who your mapping specialist is and get you directly connected so they can create. Why would you ever lend outside of the policy when you had the means to put it into the policy? I knew I had Chris coming in, but I wanted to do that segue. So I gave myself a half hour to kind of set the stage for, if you're going to lend to someone like Chris or someone like the Fullers, why, if you have the means to do it through a policy, why would you ever lend outside of the policy when you had the means to put it into the policy? That's what I always tell people. I'm like the numbers don't lie. The math doesn't lie. It's changing one thing. It's always been that. Change one thing, and that's where your money goes first. And then everything else is the same. So I hope all of you took something out of this, and I hope all of you apply something that Stephen, myself, and Chris Rude taught you today, because it's not the knowledge, it's the application of the knowledge that always matters. It's the only thing that matters. So with that being said, folks, I'm going to let all of you go. I hope you enjoyed your 4th. Hope some of you are overcoming that hangover. But with that being said, it's time to get rid of the hangover of paying checks to somebody else's bank and take back control of your money. With that being said, we'll catch you all on the next wealth webinar, or we'll see you at Ask Me Anything at 4:30 today. Thanks. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.